Okay, thank you all for joining us today for the next episode of the On the Mark Financial Forum and podcast. Today's topic is how to successfully transition from one home to another. This is a common inquiry we get. People are really confused. It can get complicated logistically, financially, and a lot of people start to question the timing and all sorts of things. So we're going to talk through how to navigate this and how to stay ahead of that process and how much of a difference it can make if you're planning ahead as opposed to just trying to wing it and make this all happen on a whim. So I appreciate you joining us today. This is a topic we talk to people about very often, and we're in kind of unusual times right now. So we're in a situation where interest rates are elevated compared to what we've been used to over the last several years. People are deferring the planning of these transitions until they're in a situation where it just has to happen now. But people also have more equity in their homes than they've ever had because properties have continued to appreciate pretty consistently at a fairly rapid pace. Maybe it's slowed down a little bit from the COVID days, but properties are still getting more expensive. So what's happening is people are growing equity in their properties and they can put that equity to use in a productive way. But the key to transitioning, as you'll see as we go through our conversation today, is to stay ahead of it and start planning long ahead. The goal is to create a plan and a specific action plan of, for example, how much money do you need to save? How are you going to get there? How are you going to save that money? Is there a financing solution that will help you get there faster? And how do you set your target and make a specific goal for how you will achieve, or a specific plan for how you'll achieve that goal? And this is something we're always big proponents of people working with the financial advisor community. You'll see some components of estate planning in our conversation today. We are big proponents to make sure that people are getting proper financial advice and making sure that they're not just relying on us for all the advice that they're getting, but they have a good team of professionals. So if anybody is looking for referrals to those professionals, please let us know. We're happy to help you. But I wanted to go through my thoughts on this topic and tell you what our potential solutions are to help people through this transition period. So the most common concerns we see people having, obviously, affordability right now is a big deal. Prices are high, interest rates are higher. Historically, maybe they're not all that high, but we don't have much perspective over the last 20 years when interest rates have been low for a longer period of time. The financial uncertainty of how do you transition financially? How do you do it? How do you come up with the money? How do you make the payments? Are you going to have to make two payments at once? Logistics are also a big concern, especially if it's an older couple or a family or not just a single person that would be maybe a little bit easier to stay with a friend or stay with family for a period of time during the transition. And also the timing. Is the timing right? Is now a good time to upgrade? Is now not a good time? And that answer will shift depending on market conditions. But I think also people have a little bit of a lack of understanding of market trends of what's happening. People say, okay, interest rates are high, so it's not a good time, or prices are high, so it's not a good time. But you have to be aware of not only what the current circumstances are, but where those circumstances are expected to change and how you can take advantage of those opportunities. So for example, right now we're in a higher rate environment, so there's probably less buyers out there at the moment. But that's actually a potential window of opportunity because when the rates do come down, there are a ton of buyers. I can tell you we have a number of pre-approved clients who are waiting for interest rates to come down, and they're going to flood the market. And in my personal opinion, there's going to be a lot more buyers coming into that market when the rates are lower than there are sellers, even though more sellers will enter because now it makes sense potentially for them to get rid of that 3% mortgage rate that they're holding on to so tightly. But you have to understand these market conditions because when rates come down, in all likelihood, prices are going to go up because there will be demand outpacing supply. similar to what we have now, but probably to a more significant degree because so many people are sitting on the fences right now, waiting for those lower interest rates and waiting for affordability to improve. But again, the key is to prepare ahead of time, not to all of a sudden walk by a property or happen to be in a building and say, "Oh, that apartment looks great. I wasn't planning to buy, but now I want to buy." When you do that, what happens is your options to finance your way through that transition get less attractive. The interest rates can be higher, short-term financing can be significantly more expensive, whereas if you had planned 12, 24, 36 months ahead of time, you could save yourself a lot of cost and grief and aggravation. So what can you do ahead of time? So we do something called an annual review, which is offered to all of our past clients and anyone else who would like to do an analysis of their options to transition. So what we look at is, what would your next move look like? Let's say we're 2 years out. Okay, if you're looking to buy, let's say you're living in the middle of the city and you think, I'm gonna have children, I want to be in a better school district than I'm in now. My priorities are shifting. I want a yard, all these types of things. What would that purchase look like? How much do you think you would have to pay for that property? We can back into how much cash you would need for the down payment. Do you have that money saved or not? Is there a way that you can save it? And this is where a discussion with a financial advisor would really come in handy, is understanding the needs and how to actually make a plan to get there. Most of the time, people are just aiming for some unknown target in outer space, and they don't really know what they're shooting for, and they definitely don't know how to get there. And so they end up fumbling through the process and trying to piece it together last minute, which can be done in some circumstances, but it's not the ideal way to do it. So we look at, do you have enough funds to make the transition? Do you have enough already saved for a down payment in that price range? So let's say it's $1 million and you need to put 20% down to get a good interest rate. Do you have $200,000? If not, is that equity tied up in your property? Do you have some other liquidity event coming up, a bonus, or if you're in tech, if you have RSUs vesting, or are you expecting an inheritance or some other lump sum of cash that might help you speed up the process at which you can save that down payment? Or do you need to pull it out from a property that you currently own, the one that probably has appreciated quite a bit and one that you have some equity in? The other thing we look at is, do you have enough income to be able to support two properties at once? There are solutions, if that's not the case, where we can qualify people and ignore the expenses from their departing residents. But again, these loans tend to be a little more expensive than a traditional lender or program that would require you, if you're buying another property before you've sold your current one, to be able to qualify to carry both at the same time. So do you have the income right now to do that? And also relevant to that is, are you changing jobs when you move? So some people are relocating for a new job, or they know that they're going to take a new job or relocate to a city, maybe to be closer to family, and their job's not transferable from one city to the next. So are you going to be changing jobs? And if so, what types of jobs do you need to look for? If you're in, for example, in a finance job where a lot of the income comes from bonus, when you first transition to the new job, it's very difficult for a lender to use that bonus income to qualify, even if you have a quote unquote guarantee for the first year or two, or some minimum amount or target amount. If you haven't received that income from your current employer yet, most programs are not going to allow you to use that bonus income. So you might only qualify on salary. So having this discussion early, we might be able to tell you, you probably want to focus, if your goal is to buy a home right as you're moving, you probably want to focus on jobs that are stronger on the salary piece of the income, which is usable immediately. And in some cases, we actually have programs where you can get approval and close on the loan up to 2 months before you even start the new job. So that transition period can be really important. And also, if you're self-employed, this is even more important. If you're self-employed, what we often find is that people, write off a lot of expenses. Okay. If I had as my grandfather used to say, if I had a nickel for every time I heard dot, 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 in this case is my tax returns don't show my true income, right? It's very common. I would say that comment comes up probably with 95% of the clients that we talk to who are self-employed. But imagine you have this conversation 2 years in advance, and you know that you're going to want to buy a home in a couple years. You might be a little more cautious with how many expenses you write off because you know that you need at least 1 and usually 2 years of good income in order to qualify for that. So again, if you know what your target is, you can plan accordingly. Obviously, nobody wants to pay extra taxes, but if it means you're going to be able to get into a home and not have to take a non-traditional mortgage, which would have a meaningfully higher interest rate, these are things that you can plan for. Again, this is where you involve your CPA, your financial advisor, people like that who can guide you through those decisions and make sure that it is the right decision. Sometimes it may not be. Sometimes a traditional loan is worth paying if you don't have to pay a lot more in taxes. But these are discussions that you want to be having ahead of time. Is your credit being monitored? Do you have generally good credit? Is there a ding on there that's bringing your score down that if you know about it ahead of time and you plan ahead, you can deal with? There are credit companies we can refer you if you have this type of issue, who can help you remove things from your credit report based on the laws associated with credit reporting. So maybe there's something you need to manage as far as the balances on the accounts. If you have one example, I had a client recently who had one credit card with a large balance every month relative to their credit limit. If they spread that out over time, over several cards, the same amount of debt would impact their credit score a lot less than if they have one card that's more or less maxed out every month, right? But also if you open new accounts, that affects you sometimes negatively in the short term, but in the long term, it's better because you can spread out the balances and the charges and hopefully not exceed more than 30% usage on each credit card. But you need time to open those cards and to get past that period where the opening of those cards negatively impacts your score. In the long run, it will benefit your score. But if you have a minimal credit history, you might also not qualify for certain jumbo loans. So just understanding these things ahead of time and taking a look at the credit profile long before you're going to be purchasing is really critical, because you have time to make the changes that you need to make to put yourself in an optimal position. And then also looking at your home. So is your home in condition to be sold? Are there renovations? Like you've always known, I really need to redo the kitchen, right? And how are you going to finance that? Is that going to eat into the money that you might use for the down payment? And also, if you're going to live in the property for another couple of years and you want to redo the kitchen, why not enjoy it yourself for a couple of years, right? So how much would that cost? How would you pay for it? Do you need financing? When should you plan to do them? Should it be right before you sell? Should it be now so that you can enjoy it yourself? And what renovations and or repairs do you need to make over time so that when your property is ready to be sold, there aren't things that people walk into the door and say, oh, I don't really like that. And I'm not saying you should make your home brand new, but there may be glaring things that if you're consulting with a good agent, which we know many of, some of which are on the call today, they can guide you through what changes need to be made so that you prepare ahead of time, because those things also take time to do. If you're renovating a kitchen, you can't do it in a weekend by yourself, right? It takes planning, takes time, takes, permits and all sorts of things that can take time. But the point of all this is to make a plan, to have someone like us review this information with you, just asking the right questions. You can make a plan for all these things. Maybe you need to be careful with your write-offs with your tax returns, and you need to do, you want to do a kitchen remodel. We talk about how to finance that if you need to finance it. And also how to set you up with making sure that you have enough funds for that down payment. But if you have a target goal, you can make a plan, maybe with a financial advisor, to be able to achieve that goal within the timeline that you want to achieve it in. So that's the idea. So what sort of products do we use on the lending side? There's two main ones, and they're both geared toward pulling equity out of a home. And right now, one of the biggest challenges we have, I can tell you with certainty, very few people are refinancing their loans right now because they have interest rates that are in the 3% range. If they got a loan 2 years, 2 to 3 years ago, they probably have a rate that starts with either a 2, a 3, or a 4, right? Those rates are not available right now. Hopefully, we're trending back down to get there, or at least somewhere in that general range. But most people don't want to do a cash out refinance right now to pull out equity because they're going to give up their lower interest rate for one that is at a current market rate, which is meaningfully higher. So one of the solutions we have is to do a home equity line of credit, a HELOC. Now, the important part of this is that you can't do a HELOC as your primary residence, which is how most lenders require you to do it in order to get that line of credit, and then immediately turn around and buy another primary residence and apply for another property as a primary residence right afterwards, or even really within 6 months. Because we've seen this before. I had a client call us to bail him out of trouble where he had taken a HELOC on his primary. He was relocating to another state and then immediately tried to apply with the same bank for a primary residence in another state. And they got through the whole process, went all the way to the very end. And in the final quality control review that the lender did, they said, wait a second, you just closed a primary residence HELOC with us just a month ago, or whatever the timeline was. And now you're applying for a primary residence in another state. We know you were deceiving us on one of those two applications. We're not sure which one it is, so we're declining your loan. And they were in contract. This was a New York property where the deposit for escrow is 10%. Contingencies had been released. This person was really in a bind, and we were able to work around it. But that's just an example of a situation where you can't take out that HELOC right before you're going to move. So again, coming back to the planning aspect of this, if that person had taken out that HELOC a year prior because they were getting the proper advice and planning, that issue never would have come up, right? You can get that HELOC in advance. And that's usually the way to do it, is usually 12 or more months ahead of time. And the nice thing about HELOCs is that until you actually draw on that line, it basically functions like a credit card where you have a credit limit where you can draw money when you need it, you can pay it back. But until you draw money and actually borrow it, you don't have any monthly payments. So there's really no major downside other than just paying the closing costs, which in some cases lenders will pay for you, to open up that line of credit. So I'm always very transparent with my own real estate. I opened up a line of credit for myself. As we knew interest rates were going higher, we anticipated business would be a little slower during that period. Didn't really anticipate it was going to be a year and a half to 2 years, but that's why you plan in advance. And it's been a great way to manage expenses and to make sure that we always have a safety net for our family. But it would also allow us to be able to transition into a new home if we needed to do it. And so basically open the line of credit and it's available to pull whenever, if and when we need it. And it can be used for any purpose. So it could be for renovations. It could be for a down payment on a new property down the road. It could be for, carrying costs if you're holding two properties at once for a period of time before you sell your departing residence. So it's a really flexible product that once you get the loan doesn't really cost you anything until and unless you borrow the money. But the key is to do that at least 12 months in advance. And the alternative to a HELOC is if you don't plan ahead of time, then what you probably need is a bridge loan. A bridge loan is designed to be short-term, where it's known upfront to the lender that you are going to be paying this loan off fairly quickly, usually within 6 to 12 months. Most bridge loans actually pay off in well under 6 months. But the problem with bridge loans, and the reason they're only used in situations where you don't plan ahead, is that lenders don't really make money off of interest short term. They actually lose money on the cost of origination and putting loans in their system and everything, unless you hold a loan for at least 6 to 12 months. So usually on bridge loans, there's points associated with it. So they can be significantly more expensive to do a bridge loan than it would be to do a line of credit. So again, if you plan ahead, you could probably open a line of credit to be able to avoid the need of doing a bridge loan, and the logistics associated with that. Now, there are some limitations of HELOCs in many cases. For standard HELOCs that don't require a significant banking relationship, usually the maximum line of credit you can get is $500,000. So that may or may not be enough for you to be able to cash out the money that you would need to make this transition. If not, we could look at a bridge loan, potentially a cash out refinance if that would make sense, although that's difficult to justify in the current rate environment if you're at 3%. But you can usually get much larger amounts on a bridge loan than you could on a HELOC, in part because they're in first lien position, which banks always prefer. But they are significantly more expensive. And in most cases, what we find is that if people had planned ahead, the HELOC would have been a perfectly viable and great option that would have cost them a fraction of what it would cost as a bridge loan. So I'm going to give you a couple of real life examples because I think stories speak louder than me just talking about how this works. So we had a client who did this consultation a while back, a few years ago. They had bought an apartment just for the two of them. They didn't have kids. They lived in it for about 7 years. They had planned to start a family. They got married young, so they had planned to start a family within a couple years and knew that they probably needed to move out of their, 1-bedroom apartment and move into probably into the suburbs. They want to have a yard. They want to have good schools. They wanted to kind of prepare ahead of time, which was A+ for them. But their property had appreciated substantially over that time, so they had a ton of equity in the property. The apartment probably could have used about $100K of work. It's something that they had planned to do when they first moved in and never really did it. But it would sell for a lot more. They put in 100,000, it would probably sell for 200,000 or 300,000 more. So they were good renovations to do, and the property was still continuing to appreciate during that time. So we did the analysis. Basically, what we determined is that they would need some equity out of their property, which they certainly had. And so we decided at that point it would make sense to open the HELOC. They don't need the money right away. They don't have to take it, but it would be able to fund the renovations that they needed to do to make the property, first of all, more enjoyable for themselves for the next couple of years, but also to improve the value of the property so that people don't walk in and say, oh, this place really needs a brand new kitchen. I don't want to do that, so I'm not going to put in an offer. And the HELOC made a lot of sense because they had one of those really low interest rates that nobody wants to get rid of these days. And it also helped them avoid needing bridge financing down the road. So they could buy without a sale contingency, which in the current market and just about any market, a sale contingency is really difficult to have a seller accept. And they also wanted to consider potentially keeping that property as a rental because they knew it could support itself and also potentially increase in value. So this is one of the most common requests we get from clients is younger couples starting a family or maybe increasing the number of people in their family. They want to move to the suburbs or a bigger apartment or whatever it may be, to something that suits their family needs a lot better. And they planned ahead, and we were able to make it so that the implications of that move were far less. They were able to transition into their new home. They didn't end up renting it in the end. They ended up selling the property, and we structured the loan for their purchase around that so that they can pay down the balance and end up with lower overall monthly payments once they settled in. The other example, this is one of my all-time favorites. We had some clients who are retired empty nesters, and they wanted to relocate to closer to where their grandkids were. And they owned a townhouse in Brooklyn that they had bought 30 years prior. God bless them, right? That value went from, let's just say, roughly 100,000 to about $3 million. A great investment over a long period of time, which shows you the beauty of real estate. You don't wait to buy real estate, you buy real estate and wait. Here's a perfect example. But here's the issue. When you bought for 100,000 and your property is worth 3 million, the government's going to take a huge chunk of that in capital gains tax when you go to sell. Hundreds of thousands of dollars you end up paying to the government if you sell, right? And they wanted to basically relocate to what was a far less expensive area. They were going to look for a condo. They wanted low maintenance. They didn't want to have to deal with a yard or anything like that. So they needed about $500,000 to buy a condo in the area where their grandkids were. And they also, one of their other goals that we uncovered is that they wanted to help their kids buy their first home with a down payment, and also be able to help with their grandkids' education costs. Now, if you don't go in deep with a client, you're not going to uncover these types of things, right? We're asking the right questions to find out what they're doing. We're also interacting with their financial advisor along the way to understand their goals and to figure out how we can make it work. So here was our recommendation. We cashed out on that property. They owned it free and clear, so there was no existing lien to worry about at 3%. We cashed out $750,000, which turned them into an all-cash buyer for $500,000, and gave them $250,000 that they could then gift to their grandkids. I'm sorry, to their kids, to be able to buy their next home for their down payment. Their cash out proceeds are a non-taxable event, so you can pull out debt and use it for whatever you want, but you do not pay taxes on that as though it was income. We also talked about something that they ended up doing, which was renting their current home in Brooklyn. In part, this was along with their financial advisor and their estate attorney trying to figure out how to either avoid or defer those capital gains. So basically what they did is they rented the property instead of selling it, and they put it into a trust to make sure that it would transfer easily to their heirs. And they plan to leave the property to their children when they pass. And the reason why that they do that and defer and rent the property rather than just selling it is the capital gains. But if you sell a property before you pass, you pay capital gains on whatever the gain is, the sale price of what you sell it for, minus the acquisition price and all the costs associated with either renovating or upgrading the property and the closing costs on either side. So that would be a massive bill on their side. But if you defer that property once the owners pass away, what happens is there's something called a stepped up basis that a lot of people don't fully understand. And what that means is that the comparison of the current value that you're selling the property for compared to the value that you paid for it, the timeline changes. If you sell it the day before you pass away, it's based on the original purchase price. If it's the day after you pass away, and I'm using this day after, meaning it's after, there's more to sort out than just one day's worth of logistics, but you sell it the day after, what happens is, from a tax perspective, now the quote unquote acquisition price is what the property was worth on the day that you passed away. So $3 million versus $100,000 in this case. If you sell it for $3 million, your family pays no capital gains tax, versus hundreds of thousands of dollars of capital gains tax if you sold it right before you pass away, or any time during your lifetime where you would potentially incur those costs. So this plan saved them hundreds of thousands of dollars. It allowed them to achieve the goal of being able to help their kids with a down payment. It also helped them avoid sticking their kids with a massive capital gains tax that they would have to incur. And the rental income, this is a two-family house in a nice area, was about $15,000 a month. The cost of the mortgage was about $5,000. The taxes and insurance, maybe another $1,000 a month. $12,000 a year. So they had $9,000 a month of positive income. They avoided all the capital gains in addition to that. And of that $9,000, they used $5,000 to pay for their grandkids' private school education so that their kids were relieved of that burden. And they still had $4,000 a month as passive income that they could use to support their retirement lifestyle. So this was like, I mean, just the poster child of things that we can do when we plan ahead and we engage with all the appropriate parties, financial advisor, estate attorney, real estate agents, all the people that you need, which we're big proponents of having a proper financial team, insurance. I mean, there's so many components to this. But when you plan, good things happen. You have insight from lots of people who might, people who might care about taxes and be experts in that regard, people about financing, people about just general financial planning and achieving your goals. And this is a way to be able to achieve that. And this, we always talk about our tagline, which is a higher level of lending. This example, or these two examples, are perfect examples of what we do and the type of lending that we do. It's not just providing a mortgage, but it's really being a mortgage guru and guider to clients who are going through these big financial transitions, and making wrong decisions or not planning ahead can have a very significant impact on how the outcome works in the end. So if you or anyone is looking to have this type of conversation, please don't hesitate to reach out to us. It does not have to be a past client. It can be somebody that you care about. A lot of times people are not only planning their own transitions, but maybe they're trying to figure out what their parents may need if they have aging parents. We have some programs that are great for seniors as well, both on bridge loans and other types of loans as well. So if you have anybody that that needs help with that type of planning, or they need referrals to other financial professionals that can help them with that type of planning, because we don't want to do that in a vacuum, we are here to help. And we hope to be able to guide you and help you make these decisions and make sure that you make the most of that transition, and that you're factoring in all the different aspects of how you can approach this to make sure that you're making the most of the situation. So let's take advantage of that equity when the time is right, and we will always give you our honest opinion on what you should, and in some cases shouldn't do. And we hope to hear from you the next time you or a loved one is going through that transition. So that's all we have for today. Our next session is going to be on July 10th, where we're going to be talking about managing finances during a divorce. See people make lots and lots of mistakes in that regard. And so we want to stay ahead of that. We'll be having a divorce attorney and a financial advisor joining us for that call. So again, July 10th at the same time, we hope to see you there. And thank you all so much for joining, and we will see you next time. Take care.